Okay, so this would have been what, 185,000? And this would have been same. The net assets at book value would have been. Sorry, we gotta do this. What, 100,000? Which we really don't. We could do 130,000. Now we only get 30% of this.
Right.
So
Okay, so the amortization shouldn't have been 3,667. It should have been whatever 30% of that is, because that's what I did wrong. Okay.
okay, yeah. So they're purchased. So they're so 30% of this. Yeah, I can't remember how I showed you. To be honest with you. There's a few different ways. They all come up with the same answer. So basically, their identified assets, anyways, were 39,000.
Mm-hmm.
And so they should have had yeah. So the book value of their investment was 30,000, 30%. These two add up to 9,000. So that's the 30,000 plus the 9, which is in here. And then the goodwill would be 11,000. So they paid 50.
Okay. All right.
Yeah. So these would be the two. Yeah, the percentage ones are confused, but that's where this, extra 9,000 comes in. 30% of this would have been 30,000 plus this 9. I should look up and see how I showed you. I may have showed you completely. I want to put it into.
We did talk about goodwill on the I think 11th page, 12th page. I don't know.
Mine's blank. I know I'm lazy, but I'm usually not that. Maybe I filled in the other one instead. Yeah, that's right. I use my working one. I use my other one. All right. So yeah, let's take a look and see which one this is. Okay, yeah, so 25% of that, so that's where we get the 39,000. And this one, there wasn't any excess because this before. I can't remember how I explained this to you. I apologize.
Okay.
But, you know, this one, if you take 25% of the book value, it's 45,000.
Mm-hmm.
And so that's the sector 10 would mean that there's maybe that's the way to put it. Give me one more second.
Okay.
Well, let me show you this. Okay, so this is that book. So let's take 30%. Okay, so oops. And part of the reason why I want to do this too is that we're going to need this. Well, I don't know if we'll get to the one further. But anyway, this percentage of ownership stuff is for figuring out goodwill. It's a little easier if you buy 100% of the company, which we're going to look at next. And so then,
Right.
So the ownership in dollars for this would be 30,000 at book value. Oops, and 39,000 at fair value. So and these are the identified assets.
Okay.
So and goodwill, for whatever reason, now is termed as the unidentified assets. So in other words, there's something else that's making this company more profitable than it normally would be. So the section of 9,000 is actually in that, from 30,000 to 39,000. Now, if they paid 50,000 for something that has a value of 39,000, and this is the true, this is the true fair value of the identified assets. So there must be something else in there that's unidentified.
And that's the goodwill. Okay.
And I beat up this side because everything goes on basically at fair value. I don't know why they came up with these, unidentified asset. Because if you think about it, once you put a name on it, it is identified. It's goodwill. But
That's true.
so this is probably the most important number on that. Your percentage of ownership of the identified assets.
Mm-hmm.
Because this is what you'll compare to what you paid.
Okay.
So basically, you bought 39,000 of identified assets, and then another 11,000 of unidentified assets for goodwill. Yeah, so it is a strange, kind of a strange way of thinking about it, but it's yeah, because the unidentified asset again is this is kind of an odd one. And this is fairly new terminology.
Really?
this unidentified assets. You know, I mean, I know why they're saying it. They're saying that these are ones that you actually sat down and figured out the fair value, whereas goodwill is basically done on a business-wide basis. You know, there's no goodwill in this equipment you're building or anything else. No. If you look at McDonald's, there's no goodwill in the building. There's no goodwill in the, you know, or stove or whatever they do. You know, that doesn't have any goodwill. It has goodwill in the way the place is operating. So you can't actually look at the asset and say, okay, this thing is undervalued or overvalued, whatever. You basically look at how much money they're making. You know, so if they're making enough money that it looks like you need to pay $50,000, that's what they're going to sell it to you.
Mm-hmm.
You value business basically on how profitable they are. So if they're overly profitable, you got to pay a little extra. So, you know, I don't know if it's still this way, but McDonald's franchises used to be like, you know, half the money was goodwill. Because
that makes sense though, because they spend so much, you know, time creating a brand.
Yeah, exactly, and that's really what you're buying. A big chunk. You can buy a stove and all that kind of stuff, you know, but it's the running of the place is usually goodwill, and so that's why it's separate from the other ones. But I guess unidentified is just kind of a strange term, but it's goodwill. It is identified. Yeah, so this will be the and nothing happens, and this doesn't get depreciated or amortized. It's a it just sits there, and unless something happens that makes you write it down, it'll just sit there.
And that would be like if the brand became useless or something.
Yeah.
Or not profitable.
Yeah. So I mean, you know, suppose we have a big food poisoning outbreak at all the McDonald's. You know, people stop going there or whatever. I mean, it's unlikely that would, but it certainly could happen. And so, yeah, if they become much less profitable, you know, then yeah, you say, okay, wait, this goodwill is impaired, and you write it down or write it off completely. But unless something like that happens, something has to happen to do that. It doesn't just, you know, over time. When I was going through school, we would have to amortize it over 40 years. How they came up with that, I have no idea. But
oh, interesting.
Yeah. Nowadays it just sits. So, yep. And so so that would be the good one. Let me see if I have. Let me see if I have a solution. I should have a solution for it. I got to. This came out of a motor solution. Well, this is it. Oh yeah. Here. So this is the oh yeah. I'll send this to you. The years aren't the same because I changed them, but
right.
But this is it. So the investment was 50,000. The book value was 30. You also paid for these two additional for these identified assets. And here's the goodwill.
Right.
Yeah. What's on this?
Okay, that makes sense.
Completely different colors. Yeah, I think that this was from a different book.
Mm.
You know, this is what a different book showed it, but I'll take a look and see.
Yeah, I don't think it was in. I don't think the specific question was in the book that I saw. I mean, I read the chapter, but you know, I mean, I didn't look through everything.
Yeah. Well,
Yeah.
well, every author has a different way of showing it. So,
Mhm.
yeah.
Yeah.
So this will be the and do you want it in PDF or?
Yeah, PDF is fine.
Put it in both.
Hmm.
Okay. If I don't put something in here, they'll kick it out.
Oh, interesting.
Yeah, well, if you don't put any message in or. Okay. Okay. I think it might take a minute or two.
Yeah.
And I'll send you out the the exam, and I'll put it in for a week.
Oh, sure.
So let me how do I do that? Just to make sure I don't mess it up. Oops. I'm not typing it. I'll make it due in a week. Unlimited temps. And okay. And again, if you have any questions on it,
Yeah.
But yeah, it's odd for two reasons. First of all, it is putting things on your book, basically that you don't own 100% of, and yet counting it as if you do.
Mm-hmm.
You know, that you own so much of it that it. And the accounting that we're doing, the equity method, is basically what they do when they have an investment. I'm sorry, when they have a merger. They do during the year. They'll keep records of it, obviously, but then during the year they will keep it on books just as an investment. And then at the end of the year, we might even do one of these today. At the end of the year, they'll take both the financial statements and kind of smash them together and make one big statement.
Mm-hmm.
So, yeah, and so it's sort of like, and you see this in companies that have a lot of mergers and stuff. That you'll see, like for Ford, they'll have Ford financial statements, and then they'll have consolidated financial statements. The consolidated financial statements will have not only Ford, but all of their companies that they purchased on there at the same time. So they call that the consolidated one, and that's one of the most people look at. There is another financial statement for just Ford, but they're also going to do a consolidation at the end, and will have all of them on there.
The entire portfolio.
Exactly. Now, for the Ford Motor Company, when they just put out theirs singularly, they will still have those investments on there. Those will be listed as investment accounts. So if they own, I don't know, what are they? Granger. If they bought Granger Company, they would have Granger on as an investment on their financial statements, but they wouldn't have their cash, their assets, and all that stuff.
Right.
So yeah, that's what we're going to do today. Go over it. Kind of that. So we're going to say goodbye a little bit to the. Is that your doggy?
Yeah, I don't know, he's mad. He's like 14 pounds, but he wants you to think he's much bigger.
We have two little dogs.
Yeah.
Wait, we're babysitting my mother-in-law's big dog.
Oh, my dog would not like that.
Well, we liked it because we have two dogs. We have this old toy poodle that's senile and you can hardly walk, you can't hear. And we have this little puppy that is a rat terrier that has so much energy. And the toy poodle wants nothing to do with it. So anyway, it's good to have this big dog come by because I think it kind of fights with the little dog and the little dog overrules. Okay, so I think we'll go ahead and start with today's stuff.
Perfect.
And today's stuff is so we're going to start with the. By the way, I still don't have a book. Just so you know.
Oh no!
Not only don't I have a book, but I don't even have the. I can't get to it because it's. I can't do the ebook. For some reason they won't. They insist that I get the printed book, but they haven't sent.
Oh my gosh!
I thought they were kidding when they said they didn't have it online. Like, well, you have to. Hey.
These book companies must be making money hand over fist.
Well, but that's the thing. The online is so much cheaper, because you just put it in once and then you can sell it a million times, and a little bit of broadband, you can make tons of money, I'm sure.
No kidding.
Okay, so there's two basic types of acquisitions, and the one acquisition is when you acquire the company and then it is immediately dissolved. Right. So you take them over, you take all their assets, all their liabilities, put them on your books, and it no longer exists anymore. And that's a one-time deal. You take all their stuff, put it on your books, and you're done. There's no investment. The second type is the one that we're going to spend a lot more time on, and that is when it's not dissolved. So they buy a company, but they let it operate as a separate company. They don't dissolve it. It might be that they have a good name. It might be a number of other reasons. It could be. I know that some of these tech companies, when they buy another subsidiary, for example, if IBM buys a subsidiary, well, they're doing it usually because the subsidiary has some good ideas and all that kind of stuff, and they don't want to push their IBM culture on this, this creative group, and so they'll just have them operate separately. So a lot of times you'll have them operating more or less the way they were before. So the two types of mergers, the one where you purchase all the assets and the liabilities. You generally don't purchase it as a going concern because you're not going to run it as a going concern. And this is called sometimes called the statutory merger. And so when they have a statutory merger, this is what they're talking about, that you buy the company, take all their assets and all their liabilities, and that corporation no longer exists, and everything that they have is put into your company, under your corporation. Okay, so one that is not dissolved, this is one that's far more interesting because you'll have companies operating parallel to each other, and operating and doing their bookkeeping and all that stuff as if they're two separate companies. And then at the end of the year, you will take them in and put them together.
Mm-hmm.
Okay. Basic concepts of acquisition: amount paid, consideration transferred. This is usually in cash or stock of the parent or some combination of. So usually you're talking about either cash or stock of the parent company. It could be other things, but usually that's what it is. So you buy with cash, or you give stock of the parent company to the owners of the subsidiary, and then you take the company. So you actually issue more stock. You're trading your stock for their stock, basically.
Oh, okay.
And yeah, so usually there's that's and then a lot of times your bigger mergers, that's the way they do it. We'll give them
That's interesting.
shares of their own stock. Well, it eliminates the need to get millions and billions of dollars of cash. And,
Right.
So yeah, so a lot of them, they'll either have cash, stock, or some combination.
And then if they give them the stock, I assume they're not giving them enough stock to have any sort of say over the purchasing, over the company that did the purchasing.
Sometimes yeah, sometimes no.
Interesting.
EDS, Ross Perot was EDS, and they gave him General Motors bought him out and gave him EDS out and gave him a couple billion in stock. And he was on the board of directors, so he had some say in the company. I mean, obviously he didn't control it, but he had some say.
Right. That's interesting.
Yeah, and they have weird ones too. They have weird ones for smaller companies, but bigger ones. Okay. So fair value received. Amount paid equals the fair value. There are no special rules. So you buy, the assets are exactly what you paid for them, the identified assets.
Mm-hmm.
Yeah, so the identified assets are the only change. So, their inventory is worth $10,000 more, but you pay $10,000 more for the inventory, and that's it.
Mm-hmm.
Okay, if the amount paid exceeds the fair value of identified assets. So the amount you pay is more than the identified assets. We kind of just went over this. Goodwill will appear on the balance sheet. The unidentified asset of goodwill.
Mm-hmm.
And by the way, because this is new terminology, if you're taking the CPA exam, this is more likely to show up.
Oh, interesting.
Yeah, they always try to, whenever they come out with a new rule. It used to be they'd wait a year. Now I think it's like 6 months. But, the unidentified asset. So if you see the term unidentified asset, what they're really talking about is goodwill.
They update the CPA exam every, 2 years or something? Or put new stuff after 2 years of review, or what is it?
They do have periodic reviews and changes, and they actually just did a big change of how they present it. But as far as the material is concerned, they update it continuously.
Oh, interesting.
But
Okay.
there's a 6 month wait. So if they come out with a rule that is, is going to be used by accounts, it's going to be it's going to be 6 months after the rule is released that it will appear on the exam.
Interesting.
It used to be a year. It used to be had a year. So you go to the next year, and so on. But now they do it every 6 months. Okay. If the amount paid is less than the fair value of identified assets, a gain on the purchase. This is another really strange new one. Will appear on the income statement. So this is sort of like, they used to call this bad will. It used to be if you paid less than the identified assets.
Interesting. I've never heard the phrase bad will.
Yeah, and you probably never will again because they call it gain on purchase now. But it was when, and here's the thing, if you talk to people in business, someone will say, well, goodwill just means you paid too much. And bad will is actually good, because you paid less
Right.
than the fair value, you got a deal. Yeah, but so this is when you actually pay less than the fair value of the asset. It could be because the company has a bad name or something like that. And it could just be because you right place, right time, and you had the money to do it or whatever. So, the purchase will show. And this is very strange. And here's why. It's this gain on purchase. Generally speaking, you never are able to record a gain or a profit on a purchase.
Interesting.
In the past, it was all before this rule. Basically, it was always you don't recognize the gain until you sold it or got rid of it or whatever. But this is that on a purchase, you can recognize a gain. And so that it's a little bit for old folks like myself. This is like it would be a fraud if you recognize the gain on a purchase. Whereas nowadays, that you have to on this, the amount paid is less than identified assets. And I think I have let me pull it up. I don't know if this is enough to go into, but this is just a little thing on bargain purchases. So, oops. Yes. Just a tiny bit small. So, for instance, if it's a merger and you buy, let's say they don't have any liabilities, you buy their equipment, land, and buildings. There's total value of $1 million, and you paid $900,000. So you paid less, right? And so if it's a merger, you will recognize $100,000 gain. You put all these will go on at exactly the same price. These all go on at the same price. The fair value.
Right.
Is your bargain purchase. Now here is the weird thing. If it's not a merger, if you're just buying this from some other company or business, it's not a merger. You're just buying assets. So if you buy a group of assets that is not a merger, you actually will allocate different amounts to based on how much you paid. So if you paid $900,000 for these $1 million, so you basically paid 90% of the value. You'll multiply everything times 90%. So this will be equipment at 90%, so on and so forth for all of these.
And you'll never acknowledge that you got a bargain on the equipment or whatever.
No, exactly, and that's and this is the way that they did it for years. This is the way we had to do it,
even if it was a merger.
Yeah. Right. You didn't recognize the gain on any purchase, no matter what. So this is the way, and this is still done if it's just a purchase of assets. It's still, so there is kind of, in essence, they're the same thing. But if they're considered a merger, they take over the entire business, then you pick up a gain, and that's a one-time deal. I think the reason they do it is this. I think that the reason they do it is usually mergers are bigger than purchases of assets. Gain on a sale is probably, or on the purchase is probably fairly rare. But also you might be talking about very large numbers. So if you were to reduce them, it would show that you're being more profitable in the future than you really were. You know, if you are making earnings based on $1 million worth of assets, and you're only showing 900,000 worth of assets, you're going to look more profitable than you really are. It's going to look like you're doing more with less assets.
Right.
So I think that that's the reason, is that these were generally bigger numbers. Okay, if they're all 100,000, probably doesn't make that much difference. But suppose these were 300 million, you know, 300 million, 200 million, 500 million. All of a sudden, it can really have an impact on you know, the profitability and all that kind of stuff, because you're going to be depreciating these, you know, based on these larger numbers. Whereas down here, these are smaller numbers of smaller depreciation. So it is a little bit of a two different worlds kind of thing. That if it's a merger, you recognize the gain. If it's not a merger, you don't. And I thought that they would change this one, but they haven't changed it yet, as far as I know. I'll check it out again. Yeah, they kept it. Okay. All right. Combination costs, and the question is, on these combination costs are where do they go? Direct costs are expense. So you know, you have people working at external brokers, the accounting people, you may have consultants and that kind of stuff. Indirect costs are expense. So you have management working on this merger, you have people that are putting, you know, trying to get your systems to match up and all that kind of stuff. Those are also expense. The only things that aren't expense are the securities issuance and registration costs, and those reduce the additional paid-in capital. Those reduce the amount of stock of value that's given. So if you buy something for $100 million worth of stock, and it costs $1 million for the registration and all that kind of stuff, then you may say, okay, I really paid $99 million. We reduce the amount of consideration that we gave because we're not going to see it. You know, if you were to sell that,
right,
you'd see that money. Okay.
Okay.
Consolidations. The consolidations, we will. We'll probably get to that a little bit later, but the consolidations are basically when you have the company is not dissolved, you keep it separate, and you take the two companies, kind of smash them together. Now there's a problem though, and the problem is that investment account, because the investment account on the parent company basically is the entire other company. So if you take their financial statements and just put them together and say, okay, let's take the balance sheet and just add everything together, you're going to be counting it twice. You're going to pick up their assets and liabilities, and you're also going to have the investment account, which really is the entire other company. So, and we'll get to those. Those are not those are like pages 8 and 9.
Okay.
All right. So now here's the nice thing about what we're doing now with the 100% purchase, because we don't have to worry about you buy 30% of it and all that kind of stuff.
Right.
So this is so all of these are for this chapter. We're going to be 100%. Okay. All right. So this is when it's dissolved. All right, so we're going to say, okay, this is dissolved. Now, we'll go ahead and they paid $150,000 cash. And this was worth
270.
Yeah. That was good.
Yeah, I don't think I have
So this would be worth 140.
And what else would be 120?
Oh, okay.
Yeah.
Okay, so
Yeah, of course, go ahead.
the net assets. This is really this is really the identifiable assets. Book value would be what, 130, which we probably don't need. And this would be 150, which sounds right. If we're just, if we're just simply getting rid of it, or folding it into our company.
Yes, just give me 1 sec. I want to check. with
Okay,
my
so what
wife
we're gonna
if
do
she wants to put this on.
is,
Oh, yeah, no problem. Sorry. I can do this real quick.
Okay.
net fair value.
5555179.
And
And date of birth is-
bought this for exactly what the identified assets are.
Right.
Yeah. Yeah, just give me 1 second. To know it.
Okay. Now, a lot of times for these consolidations, you'll see them have current assets all lumped together. So this could be cash, accounts receivable, inventory, all that kind of stuff. You'll often see these lumped together.
Right.
Sorry about that.
So, okay, so I'm gonna put these on the books. And basically, it's like coming down. I do have it. Okay. So, the assets are all going to be debits,
Right.
and the liability will be
Mhm.
okay. And you're going to put them on the fair value. And accounts payable. Accounts payable goes on, yeah. And we gave them cash. 150,000.
Right.
I think that's it. Not a bad idea to add these up and make sure. Debits equal to credits.
Brought my calculator this time. Yeah, so those are equal. They're both 270. Which makes sense because that's also the net assets under fair value.
Yeah, exactly.
Yeah.
Those are all the debits. So if this ID equals 270.
Right.
So that's it.
Okay.
The same problem. Same.
It's just a different amount of cash. I'm not seeing anything else different about the problem though.
Yeah. Like it's the same. I think I did this as a. Oh. Okay, so this was what, 270? Oops. Oh, okay, there we go. Okay, so this is when you paid more than the identified asset. So in other words, there must be some unidentified assets. And I think I'm gonna put it the same way that the other one was. So consideration paid, I think was cash, right? So cash. Okay. 174,000. Identified assets, oops, was 270. No. I think before I had it as excess. Well, I'm not sure the best way to put this up. All right, so this would be so the I think the way that they had it was this. Excess assets were 20,000. I think this is what it was put in there. And so this would be the unidentified asset or goodwill. uh, 24,000. And there's other way you can think about it. I mean, if the value of the identified assets was 150, which is basically those two together. Again, I'm trying to kind of keep it the way that they show it for the, this is basically those. So the goodwill is the unidentified would be 24,000. because, you know, this is really just that. I should probably not do it the same color. Right? That. That. So the goodwill, the unidentified asset is 24. To me, the easiest way to do it is just to find the what's the fair value of the place, and what did you pay? You know, if you find the fair value of the place of what you bought, and then say, okay, if we paid more than that, there's a goodwill. If we paid less than that, it's a gain. If we paid exactly that, it's nothing. You know, and this book value plus the excess identified assets, that's just the fair value. You know, that's the fair value of the assets. So I would just say compare this versus what you got. Okay, so the journal entries are going to be exactly the same with one exception. So they're going to be the same. Two exceptions. The cash paid was 174. So this one is different. And we need to do one more thing. First of all, these two sides are not going to balance if we just put that to 174. So what else do we need to do? We have all the assets on the books except for
Oh, geez. Sorry. Sorry. I don't know how I ended up on mute. I was going to say, I'm not sure. Obviously, there's the 24,000 for the unidentified asset, but I thought we didn't put goodwill on the books. So I don't know what.
No, you do put it on the books, but you don't amortize. You don't reduce.
Okay.
You don't write it off over 5 years or 10 years or whatever.
Okay. So you say you can just put that on there as goodwill.
It's goodwill, and again, unless something happens, it does just sit there forever. So this is the goodwill part of it.
Mm-hmm.
And that's why I don't like the term unidentified asset, because it's identifying an asset that exists because the company is run better. But
that makes sense.
But don't listen to what I'm saying. Just take the CPA exam. Well, Mark thinks, who cares what Mark thinks? So yeah, so this will go on the books as goodwill. You paid more than the identified assets. You probably paid for more because it's probably more profitable than the normal, whatever this is. All right. The next one has to do with a gain, I believe. Yep. So again, the next one's everything's the same. And this, we only paid 132 for. So everything else is the same except for cash that we paid was 132,000, which is less than the
Right.
150. It's worth 150, we paid 132.
Mhm.
So if you subtract out, this will be a gain. So 150 at 18,000. So this would be,
Yeah.
and again, this used to be badwill, now it's just a gain. One thing about this is that it actually is much easier than the way it used to be. Because the way it used to be, we'd have the things like cash wouldn't get that 90, you know, it said that we allocated like 90% or whatever in the previous, when I showed, on this,
Right.
I showed you like, well, that didn't apply to all of the whole purchase. So you had things like cash, accounts receivable that would be on it dollar for dollar. It was really confusing to be quite honestly, to allocate it out. Whereas now it's a game.
So funny. Yeah.
At first I was mad about it, but then I realized how easy it was. I changed my mind. Okay, so this one would be there's definitely not any goodwill. Cash was 132.
Mhm.
And we are going to put that gain on the books, and again, very unusual. Gain on bargain purchase. So this will show up on the income statement as income. Or the other revenues and expenses, this will show up.
Okay.
And these will all be on the books. You'll notice something here, like these identified assets. These are all going on at whatever price or whatever the fair value is. So all of these are going on at fair value. And this is kind of the reason why they did it. They said, okay, these are really what these assets are worth. And if you put those on a different value, it's going to make you look like you're more profitable than you really are. So,
Mhm.
and it's going to reduce your expenses because you're going to be expensing something that should be on the books at whatever 100,000 is on the books at 90,000.
Right.
Okay, so that is when we dissolve, we buy a company and dissolve it. So it's when the it's a one-time deal. Once these are on the books, that's it. You know, there's nothing to do in the future. Whatever you did, 2021, going to 2022, nothing. All right.
Okay.
Now, when the company is not dissolved, so when the company is not dissolved, the question becomes, well, what do you do with it? Well, whatever you pay, whatever the consideration paid is, this is the same one. No, it's different. A little bit.
No, because this one's not dissolved.
No, but I mean the dollar amounts. These aren't.
Oh, no, not exactly the same.
Yeah. $165,000. Let's say identified assets, by the way, I mean identified assets and liabilities. Although usually the liabilities, just because of our regular accounting, the way we do accounting, are usually on there pretty close to what their fair value is, just because of the accounting rules we already have. It's
Right.
possible they could be a little bit different, but for the most part, they should be pretty much the same. Okay. Is this 110? Oops. That's not how you do it either. 125. Yeah, this is more. So this will be buildings have an excess. Okay. Okay, so they have a corporation issued $5,000 shares from a okay, so they have 5,000 shares. It was $5 par value.
Yeah, that's no problem.
Mhm.
The market a $27 fair value, and they gave them 5,000 shares. Okay, so the consideration given here would have been
Stock.
yeah. Would be 5,000, and you put it on there at what the fair value is. 27.
Okay.
For a calculator. $35,000. Okay. Just say net. Okay, so their consideration is that. If it were me, I would just compare it to the 120.
Right.
But you could also, the way they usually show it, so they say, so fair value of net assets is 110. I mean, the nice thing about that is putting the excess in though is the, you got to pull it out anyways if you're going to do the amortization. Okay, so this would just be, so we'd have goodwill of what is it, 15,000? Yeah.
Yeah.
Okay, so let me the goodwill. And here's the kind of unusual thing about this. We put all this into an investment account. When we buy this company, we're not going to put all these, we're not going to put the assets and all that kind of stuff. We're just going to stuff the whole thing into an investment account for what we paid for. Now, later on, when we combine them together, we'll worry about this other stuff. But,
Right.
right now, we're just going to put it into an investment account. So if you 135,000. And the oops.
We got the register, the accounts that we have to debit. The registration fees.
Yeah, I'm going to do those separately.
Oh, we do those separately. Okay.
We'll do it separately. And come on, the idea will be exactly the same. So this would be common stock. $5. So 5,000 minus 5. $5,000. And additional paid in capital. Will just be the well, there's two ways you can do it. Additional paid in capital is what was paid above the through account is additional paid in capital in excess of par value. So, and by the way, you see this identified as APIC, and I've seen registered financial statements that call it APIC. In this case, it'd be 110. But basically, it looks like this. If you were to do the calculations, it would look like they're paid $27 minus the $5 par equals $23 of APIC. Dollar sign in front of those. And APIC is usually what we capitalize. And then if you take 5,000 times
$22 APIC.
oh, you're right.
Yeah, I just did the math at the 15, and I came up with 15,000. I was like that, or 115,000. I was like, that can't be right. There's okay.
So yeah, so this, now you could also, I mean, the easiest way is just take the total subtraction. But,
Right.
this is kind of the mathy form of it.
Right.
Now these other fees, though, let's see.
Right.
Legal fees of 1,000 are just going to be expense. Yeah, I don't even know what to call it, but something.
Right.
And see. And the additional paid in capital. And you'll notice something here that this is this cash we have to pay out because we actually didn't sell the stock. It isn't like we sold the stock and they withheld $1,200. So if we issue these shares, we're just going to have to pay cash for them. And that will come out of our additional paid-in capital.
Okay.
Okay, now this one is going to be a little bit different because everything will be the same basically.
Oh, yeah, it's from when I remember I had my identity stolen a few months back. Yeah, let me, my wife's in charge of all our financial stuff. Let me just check with her and make sure. Yeah, let me just check with her and make sure that it makes sense for us to unfreeze it. So basically, so you said just call all three bureaus and ask them to take the block off the account.
Okay, so in this case, the fair value was $23. That's what's where you got the 23 from.
Yeah.
Oh, yeah. That makes sense.
Okay, so this is $23. So here's the thing: 5,000 times 23.
Right.
I should have made both there. Let me make this one blue. Okay. So this is the 23. Okay. Well, 115, right? I'm cheating. I think you told me it was 115.
It was, yeah, 150.
Yeah. So
What? I'm sorry. Yeah, 115.
and so here is the difference on this one. That we have a book value of net assets equals. So we have a bargain purchase.
Mhm.
I did this wrong. Gain on 5,000.
Yes. Yes.
Okay, so this is where it gets a little bit different in that we're going to put this on the books at 120. So this is a little bit strange because when you think about it, all of those assets we're going to put on the books are going to be at the fair value. So we're not going to put this on the books for what we paid for it. We paid less than the fair value. So we're going to put these on the books at the fair value. So this investment will be on the books at $120,000.
Mm-hmm.
Oops. Common stock. The same as before, right? $5 each. Right? 5,000 times. additional paid in capital. What we'll do before, you think with 115 minus the 25. What is that? 90? It's 90,000. But anyway, you could also do it the 23 minus that number par equals $15. You want to check. And so 5,000 shares. Equals 90,000.
Wait, so then we're still off by $5,000. Am I wrong?
You're right.
What's the $5,000?
What is the 5,000? It's the weird one we talked about.
Oh, wait, is it because the investment consolidation is for 115,000, not 120?
Yeah, this is gain.
Oh, the gain, that's where the gain is. Okay,
Yep.
I got you. That's, yes,
And again, that gain is just 1 year
right.
and it's done. And it is a very strange thing to recognize a gain when you purchase it. But again, they're doing it so that the assets are on the books at the fair value for what they really are.
Right.
I think we're going to stop here.
Okay.
Because this other thing we're going to do is takes a really long not because it takes a long time, but because we're going to fold this into another one just to kind of give you a heads up. It's when we actually do the consolidations, first kind of consolidation we do.
Mhm.
And that we're going to have you consolidate. You remember by the whatever acronym SADI.
Right.
And so the one we're going to do is stock and excess assets. So this is chapter 2. But then we're going to have this chapter 3. So I usually don't have a exam on chapter 2 for the consolidation.
Mhm.
Consolidation doing chapter 3.
Because it all feeds into chapter 3.
Right.
Okay.
Yeah. So I think we'll hold off on that till next week, and doing it all
Okay.
at once will probably make more sense anyway.
Well, that makes sense.
All right. All right. Yeah. So I gotta send you the test, don't I?
Yeah, so send me, so the test for chapter 1, and then you said there's no test for chapter 2, but is there a practice exam for the questions on chapter 2 that we did so far?
No.
No, okay. So just chapter 1.
Yeah. So just chapter 1 now. Yeah. So that's what we'll do. So chapter 2. Let me think here. I'm not gonna go over it. Yeah. So we're going to focus on the consolidations.
Okay.
This stuff down here, and just to give you kind of a heads up. So this is Amy and Bill company. So Amy bought Bill, and just to let you know, so this bill here is the same as all of this.
Mm-hmm.
All oops, that's not Bill. This is Bill. You know, so this is Bill, and then this is Bill. So if we just take them and smash them together, we're gonna double count Bill. We're gonna have an
Right.
investment of 9,600 plus all Bill's stuff, so we're double count, so we eliminate this investment. We'll get into that next week.
Okay, perfect.
So we will stop that, and I will send you an exam in, let's say 10 minutes.
I can take 10 minutes to drink some water or something.
So I'll have the separate one, so you can put that in the other week.
Perfect. Okay.
All right,
So when
well,
are we meeting next then?
what works for you?
I mean, yeah, I can do Mondays or Fridays. You said those both worked for you. So I could do Monday or Friday. The only day that I think would be a problem is the 25th. I can't do class, so I could do that earlier in the week though, if that's okay.
Well, that's fine.
Mhm.
Okay, well, let's keep it. Now, do you like 4:30 or 6 o'clock, or does it matter?
Probably earlier is better, but it's not the end of the world either way.
Okay, well,
I don't have anything.
we'll do 4:30. We'll do 4:30.
Okay, 4:30, perfect.
And thank you so
Alright.
much for making the accommodation.
Oh yeah, not a problem. I know, you know, obviously everything's all still very weird with COVID and everything and all that. So obviously, but I've got flexibility. So
Okay, all right. Well, thank you so much. All right,
All
and
right.
Well, you'll get a test emailed to you momentarily.
all right, and I'll see you on the 18th.
Very good.
All right, thank you. Bye bye.